Ever wonder why some people waltz into real estate investing while others feel like they're scaling Mount Everest in flip-flops? The secret might be hiding in your birthday cards. Now, picture yourself sitting across from a mortgage lender, hands sweating, wondering if grandma's generous $20,000 gift is actually going to help you snag that rental property. You've got the property lined up, the numbers make sense, but there's this nagging question bouncing around your head like a pinball. Here's where things get interesting. Gift funds are totally legitimate for buying a primary residence. Lenders practically encourage it. But rental properties? That's a whole different ballgame, with rules that seem designed to make your head spin. The first curveball is something called skin in the game. Lenders want to know you're personally invested, that you've got something to lose if this rental venture goes sideways. When Uncle Bob hands you $50,000 for a down payment, the bank starts asking uncomfortable questions about your commitment level. Think of it like this. Would you trust someone to manage a restaurant if they didn't invest a single penny of their own money? Probably not. Banks feel the same way about rental properties, except they've turned that feeling into actual policy. Most conventional loans for investment properties require at least 20 to 25% down. And here's the kicker. They want that money coming from your own verified savings. Gift funds can sometimes supplement your down payment, but rarely can they be the entire amount. It's like bringing someone else's homework to class and expecting full credit. Now imagine you're the loan officer reviewing applications. You see two investors. One scraped together their down payment over years of disciplined saving. The other got a check from mom and dad last Tuesday. Who seems more likely to weather a tough tenant situation or an unexpected repair? The underwriters are thinking the same thing. But wait, because the plot thickens like day-old oatmeal. Different loan programs have wildly different rules about gift funds. Some lenders might let you use gifted money if you're putting down 30 or 35% total, with a portion being your own funds. Others draw a hard line in the sand and say absolutely not for investment properties. Here's where creative financing enters stage left, wearing a top hat and carrying a cane. Some investors work around the gift fund restriction by having family members become co-borrowers or even co-owners. Suddenly, it's not a gift, it's a partnership. The bank sees shared responsibility, everyone signs on the dotted line, and boom, you've navigated the maze. The irony isn't lost on anyone paying attention. You could receive $500,000 as a gift, buy a house in cash, rent it out, and nobody bats an eye. But try to finance that same property with gifted down payment money? Welcome to paperwork purgatory, where every dollar needs a birth certificate and 3 character references. Of course, there's always the FHA route for smaller multifamily properties, think duplexes or triplexes. If you're planning to live in one unit and rent out the others, FHA loans can be surprisingly flexible about gift funds, since it's technically your primary residence. It's like finding a loophole written in invisible ink that suddenly appears when you hold it up to the light. Portfolio lenders are another wild card in this game. These are banks that keep loans on their own books instead of selling them to Fannie Mae or Freddie Mac. They can make up their own rules, like that kid in elementary school who insisted his house had different monopoly regulations. Some might accept gift funds for rental purchases if your overall financial profile looks strong enough. The documentation requirements could fill a small library. Gift letters, bank statements showing the money's origin, proof the donor can actually afford to give it away without eating ramen for the next decade. It's exhaustive. The lender basically wants to write a biography of every dollar in that down payment. Here's what nobody tells you at those free real estate seminars held in hotel conference rooms with stale coffee. The restriction on gift funds isn't just about protecting lenders, it's also about preventing money laundering and fraud. When large sums move between people for property purchases, regulators want a paper trail longer than a CVS receipt. But let's zoom out for a second. Even with these restrictions, real estate investing remains one of the most reliable wealth-building strategies available to regular people. Whether you save your down payment or creatively navigate the gift fund maze, rental properties can generate passive income and long-term appreciation that stock portfolios dream about. The adaptation happens constantly in this industry. As lending tightens in one area, investors find another entry point: seller financing, private money lenders, partnerships, house hacking. The strategies multiply like rabbits because the underlying opportunity remains incredibly compelling. Fast forward to today, and you'll find investors closing rental deals with all sorts of creative financing structures. Some use their own funds, some partner with family, others leverage retirement accounts through self-directed IRAs. The gift fund restriction hasn't stopped the rental property train, it just made investors more resourceful. So can you close a rental purchase with only gift funds? The short answer is probably not through conventional financing, but the longer answer involves more variables than a calculus equation. Your best bet is talking to multiple lenders, exploring different loan programs, and maybe getting creative with ownership structures. Companies jumped in with both feet. Suddenly, streaming services are hosting 8-hour Yule log videos and aquarium live streams. They've monetized our collective exhaustion and called it a feature. And if you're serious about diving into rental property investing, you need the right tools in your toolkit. That's where Growth Sense comes in, a comprehensive directory designed specifically to help investors like you find legitimate real estate investment opportunities. Head over to www.growthsense.com and discover properties that match your investment criteria. Because navigating gift fund restrictions is hard enough without also hunting blindly for deals. That's the gift fund game in all its bureaucratic glory. But here's the thing, knowing the rules means you can play smarter, and playing smarter means building wealth while everyone else is still wondering if they should even try.